and welcome to a very special limited series podcast within the Fintech Takes podcast feed that we are calling Fintech in 2025, Where the Industry Goes Next. This podcast series is sponsored by my friends at Marqeta, and the reason that we wanted to do it was because Marqeta and I share a somewhat maybe counterintuitive take given what's happened in fintech in 2024, which is we're actually very optimistic about fintech in 2025. There's been a lot of stuff that's happened in fintech from a regulatory perspective, from a market perspective, from a technology perspective that's really shaken up the Etch-a-Sketch. And it could be easy, I think, having experienced all of that in 2024, to be a little down on the prospects of fintech going into 2025. I do not feel that way. I actually feel like everything that we've had to struggle through this year, including a lot of difficult situations like the Synapse meltdown and everything that's happened in banking as a service, the sort of drama that we've seen play out around open banking and the final rule that's come out from the CFPB, all of that to me actually makes me very optimistic that we're going to have a good foundation to build on in 2025. I'm very optimistic about fintech. And so I was looking for a way to express that optimism. And Marqeta and I decided to team up for a series of podcasts that we are going to be releasing in the Fintech Takes feed on fintech in 2025 and discussing where the industry goes next. Now, this first episode, episode 1, is the Optimist case for fintech in 2025. I wanted to start by having a broad-based conversation on what some of the impacts of everything that's been happening this year are going to have for going into next year. So couldn't think of a better way to do that than to talk to the CEO of Marqeta, Simon Khalaf. And so we actually got a chance to sit down live in person at Money 2020 in Las Vegas to record this conversation and to record all of the subsequent episodes of this podcast series. So I'm going to go ahead and drop you right into a live podcast with me and Simon talking about the Optimist case for fintech in 2025.
Hello, and welcome to the Fintech Takes podcast, recorded live from Money 2020. This is so much more fun than recording in my house alone. This is so great. Thank you. I am delighted to be joined for this podcast, a series of podcasts that we're recording live with Marqeta at Money 2020, trying to express a little optimism about the future of fintech. And couldn't think of a better guest to start that process with than Simon Khalaf, CEO of Marqeta. Simon, thanks for joining me.
Thanks for having me. Appreciate it.
Awesome. So, Simon, the thing I've been thinking about a lot, and people ask me about the future of fintech, what's going to be happening. The questions I get around this tend to be with sort of a glum face. People are like, oh, fintech, man, it's been a lot this year. And while it has, my outlook for the future is actually very optimistic. I think we're headed towards a great 2025. It's kind of counterintuitive maybe based on everything that's been happening, but I'm very optimistic. I know you are too. So I thought maybe we could explore some of the different elements of why we're a little optimistic about fintech in 2025, and then maybe I can get you to do a little prognosticating about the immediate future. Does that sound okay?
That sounds great.
Okay, so the first thing I wanted to ask you about, if we explore different areas for optimism, and again, I'm going to take this sort of counterintuitive approach a little bit, is I wanted to ask you about regulation. Because I think probably that's the defining story of fintech in 2024, is that regulators in many different respects caught up to fintech, right? And to a degree, there was some pain associated with that. I think anytime there's a massive surge in innovation, regulators, just by the nature of what they do, are going to be a little behind the curve. But as we've seen with partner banking, with banking as a service, with a number of other areas, regulators have caught up to this space. Again, some people react to that with a sense of gloom. I'm sort of optimistic about what that's going to mean for the future of fintech, but how do you think that's going to affect the next year or two?
Well, the first thing I say is I really appreciate your optimism because we're extremely optimistic as well. And it's very simple. This is a $150 trillion industry. So, of course, we're going to be optimistic. All right. And if you look at technology in general, the internet and AI have almost disrupted every industry. with the exception of fintech, because they're afraid of regulators.
Yeah.
But honestly, there's nothing to be afraid of, because we are so aligned with what regulators want. I can guarantee you that you can interview every Marqetan here. Not a single one of them want a hacker on their network.
Yep.
Not a single one want money laundering on our network.
Yep.
Not a single one want to do unfair lending.
Yep.
So, and this goes on and on. We are so aligned with the regulators, but we appreciate and understand that technology moves so fast, and we use 3-letter acronyms that we change them every couple of months, and regulators have to understand it, appreciate it, and adjust to it.
Yep.
Right. Let me tell the entire fintech industry, there's nothing to fear, because they're on our side. And the reason they're involved now, because we're important.
Yeah.
We have become too big to fail.
Yeah.
So the first thing that you can tell that this industry is going to about take off is where we are in the cycle. I go back to first they ignore you, then they ridicule you, then they fight you, and then you win.
Yeah.
So they can't ignore us anymore. So they're joining us.
Yep.
And they're guiding us. Yes, it could give a few setbacks here and there, but that transformation has become, and there's nothing that's going to stop it.
Yep.
So because it makes sense for consumers, they're delighted. They're delighted. It makes sense for businesses because they're selling more. And honestly, it makes sense for the ecosystem because we've seen it. Whenever there's innovation in any form of financial service, any form of capitalism, we've seen it over the last centuries that good things happen.
Yep.
So I think that your optimism and mine are very well warranted.
I completely agree with that. The thing I would add as it relates to the regulation in particular is I think one of the challenges we have with regulation is it's really difficult to regulate an industry that you don't understand, right? And it's really difficult for participants in that industry to figure out how laws that were written decades ago apply to them, right? And so one of the things that has been happening a lot on the regulatory side is regulators have been educating themselves on the models that we have in fintech, right? I spoke to a group of regulators a year ago, and the questions they were asking me about banking as a service were pretty rudimentary, right? They were pretty simple questions that I sort of naively would have hoped they would have known the answers to already. But fast forward a year, I talked to the same sets of regulators. Their knowledge of what's going on in banking as a service, in fintech, in crypto, in a number of different areas has advanced by leaps and bounds. And I think that that is a sign that they're catching up. And then what's happening is, because of what you said, all this progress we're making, the traction that fintech is getting in the market, regulators have had to update their guidance. They've had to update their rules. They've had to accommodate for what's happening in fintech. And so I actually think that the regulatory clarity that's going to come out of this year is going to give a really good set of rules for the road for everyone in fintech to build against. And I'm excited to see, when you know more clearly what the rules are and how they apply to you, how much faster we can go while still being safe. Does that make sense?
Yeah, absolutely. I mean, the idea here is to disrupt, but disrupt responsibly.
Yeah.
So, and the definition of responsibility is what we are talking about.
Yeah.
And I do agree that the fact that we are getting the attention we deserve from the regulators is going to give us a much stronger platform to leap from.
Yeah.
Because no one wants to move slow, but the tech industry is actually very well known for moving fast and breaking things.
Yeah.
But when you're dealing with people's money, so, I mean, Marqeta is now $300 billion in total processing volume, growing 30% year over year.
Yeah.
So with reach comes responsibility. So we cannot move fast and break things. We have to move fast while respecting the rules, the laws, and regulations.
Yep.
So I think that if we get this contract, this agreement now with regulators, while we're still at 300 billion, it is actually much, much better than having to take a step back when we're at 4 trillion, 5 trillion, and 10 trillion. So getting this understanding among ourselves and the regulators, the banks, our banking partners, let's do it now. And let's actually continue on solid footing. So I think I really love what's happening in our industry right now.
Yeah, no, I think the only thing I would add to that is just that you make a really good point. I sometimes think of fintech as like sort of a teenager that's sort of maybe getting towards college, but it's like there are these windows of time as you mature as an industry where there's a right time to solve some of these issues. And I think you're right. Like if we got to a bigger scale and we weren't learning some of these lessons, it would be that much more painful when we had to learn them. I mean, I always sort of joke that like you can't delay inevitably what's going to happen in financial services. The credit environment's going to change. The macro environment's going to change. Regulators are going to catch up. There's only so long that you can ignore those things. So better to get it out of the way now. The other thing I wanted to ask you about, speaking of a solid foundation to build on, is infrastructure. So I think we get a little frustrated in the U.S., especially when we look around other parts of the world, that our infrastructure isn't maybe advancing in financial services as fast as we would like. We've been waiting for real-time payments. We've been waiting for open banking, at least in a regulated context. But we actually have some of these things now, right? Like it's taken a while, but we actually have meaningful upgrades that we've made to infrastructure. I'm curious, when you think about it from an infrastructure perspective, again, kind of painful, maybe the last couple of years. We've been working on finalizing the rule around open banking. That's now final. We've been waiting and waiting and waiting for FedNow. That's now out in the market. What do you think some of these infrastructure advancements are going to unlock?
Sure. I would say that, look, we have to be ourselves worst critics, but as an industry, we've done actually a good job over the last 50 years. Because if I look at it, 20 years ago, used to travel overseas, and your card works everywhere, but your internet connection does not.
Yeah.
You get to a hotel and you plug into the phone line and you still hear, that was 20 years ago, the beep, 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 until you get to a modem. By the time you get authenticated and get your email, it's actually over 45 minutes. While you can go down and within 6 seconds, you can pay anywhere in the world.
Yeah.
So we have wired the planet from an infrastructure perspective, and MasterCard, Visa, Amex, and many others have done that. Now in the United States, you're absolutely right. I mean, like I was in Europe this summer, and honestly, I didn't take banknotes with me. I didn't take a single credit card.
Yep.
But heaven forbids you come to a restaurant and you want to pay with Apple Pay, and everybody looks at you in a weird way. So I think it's cultural.
Yeah.
Anything is going to change. From a platform perspective, honestly, everything's there.
Yeah.
Like the wiring has happened. So call it layer 2, layer 3, layer 4, even layer 7 is there.
Yeah.
So from a security, privacy, compliance perspective, but I think that we're a card society, with a credit card society, right? And we're used to the safety and protection that cards have given consumers, and that's not going to go away.
Yeah.
Right? There's room for everyone. Again, I'm back to $150 trillion industry. There's room for open banking. There's room for cards. There's room for everything. So I have to say the infrastructure is there. We have to make sure that the Chrome around it, the user experience is extremely solid, and we do not go back with and have a relapse in security, compliance, chargebacks, and disputes. We have to make sure that the consumer are protected and the businesses are protected, even if the plumbing is there.
Yeah, I mean, to build on that point, one thing I'll taken a lesson from is when we introduced Zelle into the market, it was a really interesting test case because it was our first sort of foray in the US around real-time payments. And what was interesting to me about it was, to your point about the consumer experience, the move to real-time payments around Zelle really had a lot more to do with the banks wanting to compete with Venmo and with Cash App and those ones. So, hey, we'll have this competitive differentiation because Zelle is real-time by default. We didn't really necessarily think through what real-time by default would mean for consumers, right? And so to your point, I think the lesson we've been learning as the infrastructure has jumped forward is, what are the other things we need to do to make people feel comfortable with this infrastructure? And I think real-time payments through FedNow is going to have an impact there. I think that open banking, I was talking to Director Chopra last night about the open banking rule, and there's still a lot of questions to be worked out around liability, risk management, like how do we make this feel safe? banks are objecting to open banking right now because they don't feel prepared to make it feel safe. So we do have to make some more progress there. But to your point, everything is wired in. We have it.
Yeah, I agree. I mean, to touch upon 1033, which is what I think you brought up with the CFPB yesterday. I mean, here's what we're telling the banks in general and JP Morgan Chase in particular. Hey, have the consumer have a go and have their data disappear, but you're stuck with the liability if something happens to the data down the road.
Right.
Well, that doesn't make sense, right? You cannot look at the P&L and say the bank is stuck with the L, but everybody else is going to take the P. So that's actually the approach.
Yeah.
But if we actually say, look, we're all sharing the liability, we're all disclosing to the consumers where the data is going, everything is going to be okay. I think it comes back to aligning incentives, right? Banks provide a great and essential service. Granted, over the last 50 years, they have not innovated. They haven't focused on the consumer. I mean, come on. How hard is it to copy Venmo?
Right.
It's not that hard. I mean, hire 20 engineers, give them a bonus, they can get it out. But that's not what the bank CEOs are focused on, right? You look at it, I bet you if we walk to any bank, they're not looking at daily active users, they're not looking at engagement, they're not looking at their NPS scores, they're looking at Fed rates and Fed funds.
Yep.
That's how they make money. They forgot that they are in the consumer services business, right? That's okay. That's why we're here, right? Have the banks do what they're phenomenal at, which is treasury management, capital markets, lending, be able to work with capital markets to arbitrage rates, and we will provide the layer that consumers will love and will be addicted to, like any digital products. I mean, if you look at it, none of the very successful big tech companies generate their own content. They don't, right? But they are the largest media companies on the planet. So they know what they do well, which is customer experience and distribution and user acquisition almost free. But the content comes from somewhere else. And we're talking about exact same thing. The transformation of payments comes by aligning incentive and having every entity do what they're really good at doing. So, and I think that the ability of somebody like a Marqeta to come into the middle and say, look, it's Fintech. We understand tech and we understand fin, right? And it's not that, we are a gateway. We're actually a platform. You built upon us, and we will go connect you to all these banks that have no interest in talking to you because they don't understand your business. So I think that model is actually a better model going forward than liberating the customer data from the banks and sticking them with the liability that comes with it.
Yeah, no, I think that's fair. I mean, the concerns around how we essentially sort of manage the liability, the risk, the profit sharing between banks and fintechs, I think is a very, very fair concern. The other thing I wanted to ask you about, though, is the development of the next generation of fintech solutions, right? Because one of the things I think I've been critical of in the past is when we are building these fintech solutions, if we're building them in a zero interest rate environment where credit risk losses are very, very low, where capital is very, very cheap, there's a different set of incentives for how to build. And it kind of goes back to your point about moving fast and breaking things. I'd be curious, given that Marqeta has been around for a while and you've seen different sort of elements of that cycle and high rates, low rates, cheap capital, more expensive capital, what are the impacts of building in a low interest rate environment versus a high interest rate environment? And what changes are you seeing in the types of fintech innovations that are coming out now?
Yeah, I have to say that in a zero interest rate environment, everybody wins. I mean, every positive number is bigger than zero. So your ability to win is actually equalized. But if there is a rate that you have to clear, right, it becomes harder. So, and that's a great opportunity for the folks that have made it, that have trained their algorithms in underwriting, in risk management, and so on and so forth, because the risk profile has gone up. Now, at the same time, the technology has improved. I mean, you got large language models, you got AI that have developed, you have more data sources in order to do a better job in risk management. I mean, let me put it this way. If AI cannot solve risk management, there's not going to be AI. Because that's one of the easiest problems to solve.
Sure.
Right? It is much easier than having a little robot come in and assemble things on an assembly line, so on and so forth. That is actually much harder than solving the underwriting problem or fair lending. So we have to do it. Now, coming back to we know society, and we've demonstrated every economical model tells you when interest rates are low, you got an economical boom.
Sure.
Right? So, but when interest rates are extremely low, you have inflation. So it's always a balance. But I'd say that the band is narrowing because you're seeing 25 basis points on Fed rates are making a massive implication. But from a consumer lending perspective, you're still arbitraging between 0 and 25%.
Sure.
So because BNPL, as an example, 60% of BNPL is still at zero interest, while APRs are 25%.
Yeah.
So we've got plenty of headroom between 0 and 25. So I think the fintech industry is going to be perfectly fine going forward over the next decade or two.
Yeah, well, and I think the other thing with the excessive amounts of cheap capital is it does allow for a certain amount of laziness, right? And I mean, I think we've seen lots of examples of fintech companies that had no idea how they were going to get to profitability. And the reason that was okay is that fintech was kind of able to just continue on and on and on. Now there's an expectation that you do have to get to profitability. And there is sort of that operational discipline that I think is really, really important because, again, in financial services, we want this stuff to be sustainable, right? It's not a flash in the pan. You're dealing with people's money. So that sustainability, I think, is just incredibly important.
I agree 100%. I mean, honestly, this is not an exclusive club. Every industry has gone through what I call the lightning years, and it's like, okay, you look at the internet. The internet actually died in 2002.
It was dark then. Yeah.
Exactly.
Yeah.
So you had companies that were valued in the 100 billion disappear overnight. I mean, I can rattle a few, and probably you can take a list. The only one that have survived is PayPal and Yahoo Finance, and they've got something in common. They were fintech companies.
Yeah, right.
Right. And you look at it, probably every product out here, either somebody at Yahoo Finance or PayPal have thought about.
Sure.
But they were 2 decades early.
Yep.
So what I'm saying is, I 100% agree with you that if you have a business model in which you lose a lot and you make it up in volume, that has never worked, no matter what the venture industry tells you.
Yeah.
So, but if you build a business model on sound financial unit economics, it is going to work. It might take a step back here and there. It might hit a regulatory burden or wall or whatever you want to call it. But you know what? If you're serving your customers, you're serving your consumer, the wall is never that high, right? And that's, I think, what fintech and financial service need to think about. No consumer should be left behind. As simple as that. And I think there's enough unit economics to make that goal a reality.
Yeah, no, I agree. And I guess the follow-up then would be, how does this sort of shape the competitive environment, right? Because long-term, if you think about it, there is this regulatory incentive. So could we see more fintech companies become banks? Could we see embedded finance eat more of sort of traditional financial services? But when you think about like the composition of the competitive market, and obviously Marqeta serves lots of different parts of that market, how do you think that's going to evolve?
Yeah, I think we have a great vantage point by serving more than one constituent, which is we have I'd say the venture-funded, extremely smart fintech companies, and some of them are doing really well. We've got well-established companies like a Walmart that is building on top of Marqeta. They have great innovators. List goes on and on and on. But I always like to go to the behavior of teenagers and kind of project where the market is going. My daughter's 14 years old. She has an iPhone. And I'll tell you that if a store does not have Apple Pay, she doesn't go in.
Really? Is that really true? Wow.
I'll tell you more. And then it's becoming a meme. She has the Apple Card, and that Apple Card turns red if you start spending close to the limits.
Yeah.
So her FICO score has become a cult. And I think every human understands green, orange, and red.
Sure.
Right? But no one understands the FICO score, number one. Number two is when something is displayed immediately to you, you refrain from bad behavior. So
it's like this real-time feedback loop.
Exactly. It's a real-time feedback loop. And then she understands the dial, like, because she goes, I'm like, you're spending too much. And look at that Apple Pay dial. And
it's kind of like the Apple Health, right? It's the same experience. Yeah.
Exactly. So what I'm going with this is where we see the market going is the top brands, which is the top 25 apps on the iPhone, are going to be the layer between the banks and the consumer. Some of them will be banks, but some of them won't be banks.
Yeah.
Now, will they get a banking license? I think this is going to become immaterial because as an industry, as a platform, as a trusted ally for our customers, we have to set the whether we're regulated or not, we have to act as if we're regulated.
Yeah.
And we have to provide the golden standard of regulations, whether it's compliance, anti-money laundering, banking sanctions, KYC, KYB, list goes on and on and on. We have to offer it to our customers. We don't have a choice. Again, I say, like, I'll give you a stat, which is insane. I was looking at it over the weekend. Bank of America is a 120-year-old company. It was called the Bank of Italy. Anybody knew that? Bank of Italy. They were based in San Francisco, right? 120-year-old company. They have 50 million cards out there. Our partners on top of Marqeta have more than 30 million cards out there, and we have more commercial cards than Bank of America.
Wow.
So in 4 years, our customers have reached 60% of Bank of America's reach, which is a $120 million, 120-year company. So with reach comes responsibility. We have to act as if we're Bank of America, whether we have a banking license or not. It's our duty. It's our job. We're the trusted ally to our customer. And I hope that every trusted platform who's transforming payment acts this way, because I think your question of competition is so relevant. The answer is, honestly, I don't know.
Sure.
And that bothers me. But I'll tell you, the clear and imminent competitor is somebody not taking this seriously.
Yeah.
Because one bad apple is going to set us back a couple of months, a couple of days, and a couple of years, right? Because the regulators are going to look at the entire industry and consider it as one. They're going to walk the floor and they're going to come out. They're not going to remember a single company, but they're the brand of a single company, even if we spend tons of money on advertising. They're going to look at us as a cohort and what this group of people have done. And if one of them is a bad actor through intent or negligence or not taking their job seriously, that's the competition. In terms of companies competing with us it's a $150 trillion market. I don't even know how many zeros that is, honestly.
That's a lot.
That's way above my pay grade, right? But there's plenty of market everywhere you go. So I think as an industry, if I've got a message, it's please, please, please take your job responsibly. And I think it helps you, it helps us, it helps our customers, and honestly, the consumers, whether they're consumers, SMBs, or customers, deserve that level of responsibility.
I have nothing to add to that. I think that's exactly right. All right, before I let you go, you mentioned briefly.
Not going anywhere,
okay, well, good. Just stay around. Just stick around. We can just keep doing this the whole time. Right. You mentioned AI briefly before, but I want to circle back to that. Not to hit like a buzzword that everyone's hitting at this conference, but I don't think you can really talk about optimism in fintech in 2025 without at least mentioning AI. I'm curious, given your role and your responsibilities, first, how do you separate hype from reality with AI at this moment? And two, where in the short term do you actually see some material gains that we could be making?
That's a great question. Honestly, we cannot separate hype from reality because everybody's hyping. So even if
I noticed out there on the floor,
everybody is going to add AI and to whatever they do.
Yep.
But I go back to base principles. Like if you look at old times, trust was the best currency in banking. As in, like, you got communities that lived with you and they trusted you, and an investment in you, like a loan, returned to the community. What defined that trust? Proximity. Let's say if you are living in a town that has a single butcher, right? And if you don't lend the butcher, right, you're not going to eat meat for 2 to 3 months, right? That is extremely hard to do on a global basis. If there's anything AI can do is rebuild the trust relationship between a buyer and a seller, right? And that's what technology can do. But the beauty here is you don't need to worry about long-time loyalty and trust. If you compute it transaction by transactions, which machines can do, and a human can do it too, but very, very slow, and in minutes and days and years versus milliseconds. If AI can do that, we can rebuild the entire industry around that trust factor, which is computed every 250 milliseconds. Risk comes down, more capital comes, that capital goes back to the economy because you don't need high interest rate if the default rate is low. So that creates a phenomenal cycle. I mean, I hate to say there's nothing wrong with news today for AI to disrupt. There's plenty of news, right? Yes, there's great productivity apps to use with AI. But if you look at 3 areas, health science, healthcare, labor productivity, and financial services, look, that's what AI is going to transform.
Yeah.
And if we bring that risk factor down, rebuild trust between 2 constituents, the appreciation is going to be in trillion. So you'll be able to grow the GDP of nation instead of like 10 to 15% or 20% instead of 2 to 3%. This is way beyond the industrial revolution, right? This is the revolution that is computed a transaction at a time. And we have 300 billion of them. Others have trillions of them. So I think that's where AI need to be applied and focus in our industry. So there's plenty to do. There's plenty to test. We're going to get a few things wrong, but conceptually, that's what we need to be focused on.
Yeah, no, the conceptual vision of using AI to just dramatically improve the reach of these things makes a lot of sense. The trust thing is such an interesting question because I think in a lot of ways, the digitization of all of this stuff took us into an environment where we can't trust as much, right? It's just hard. And AI and the ability to sort of deliver more of that sort of transaction by transaction experience. We did a podcast earlier about BNPL where you're underwriting on a transaction by transaction basis. It's just a different way of engaging with customers. And I think
absolutely
that drives a huge amount of value.
That's why we're so excited about what we announced today, which is Flex, which is takes a beautiful product, which is BNPL, a low risk product from an underwriting perspective, lower, right? And a product that consumer are loving, and we are sending it to everywhere a card is accepted, right? Distribution is great when a product is great, right? If you have a shitty product, you distribute it, you get a lot of shit everywhere, right? But BNPL has demonstrated that it's a phenomenal product, consumer accepted, the capital market accepted it, regulators have accepted it. They have a few comments here and there which are extremely warranted.
Yep, very fair.
You take it and you make it accessible anywhere a card is expected. That's where magic happens. So, and I think we're very excited about it. So, which is really cool.
Yeah, well, you might have just answered my last question, which was one specific fintech innovation over the next 12 months you're excited about. Is it Flex? Is it something else? What's on the list of things you're just super excited going into the next 12 months?
Let me give you a concept, and I'll go. Of course, I'm going to say Flex. But I'm excited a lot of things, right? But I think conceptually, the last 5 years, we've built beautiful, highly innovative products.
Yeah.
So I'll give you an example. You look at the neobank application, and you look at a bank application, and you can visibly tell the difference. You look at the expense management application like Ramp and many others compared to an Oracle expense management.
Oh God, you're giving me like flashbacks I'm not enjoying. Yeah,
exactly, right? So you can see the level of innovation. You look at BNPL, which you are underwritten in minutes compared to going and asking for a loan at a bank. So we've innovated a lot. I think what I'm excited about is innovation and distribution. So that's how I'd like to frame Flex, as in we've got great products as an industry, right? And if you take a neobank and call it a credit union and put it underneath a Target and a Walmart and a Google and an Apple and a whatever it is, that's innovation. You take buy now, pay later, and through Flex, you get it through any card, whether it's MasterCard or Visa, any piece of plastic or any digital token. That's beautiful. You take expense management or virtual cards and you put it under any AP automation software or financial software package, right? That, I think, what 25 is going to go about, which is taking 3, 4, 5, 6 products or use cases that regulators feel comfortable with, banks have already sanctioned, consumers or customers are extremely happy about, and just dump them into massive distribution channels. I think I'm excited about that, more about it, this new like shiny object. So I think that's what 25 is going to be all about.
Innovation plus distribution. You heard it here first. Simon, thank you so much for taking the time.
Thank
this was
you,
great.
Alex. Really appreciate your time.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.